We are now joined by Simon Reid. He's the head of institutional trading at Imara Africa Securities, joining us just to talk on the impact of the euro on Africa. Thank you so much for joining us, Simon. Let's first start off with that Greek election. Was that an outcome that you had expected?
I think it was pretty much well expected. I still think the thinking man in Greece doesn't really want to throw himself to the wall just yet. The problem with it all, obviously, is it's just kicking the can further down the road, as has been happening. It doesn't solve the problem that Greece or the euro area has. It just buys more time, which in our terms sort of extends the lack of activity that we're seeing across the African space and so on for now.
Lack of activity across the African space. With Africa, it's really been known for that growth story. African countries have been able to get away from that whole recession. But South Africa, however, has been affected somewhat. Now, how are African countries going to get out of this? Because they can't really not be affected at all.
It's not really that. I mean, the lack of performance of share prices over the last 6 months, I think we found a base in the African markets, but they're not exactly running away from us. The good news is that the yields are improving all the time. The relative value that's showing is improving all the time. But the money that needs to come and find the opportunity that's out there in Africa is just not coming at the moment, and a lot of it is managed in Europe. And the fear factor out there, which is driven by events in Europe, is so big. You've got to ask the question, why are trillions of dollars still finding their way into bonds where you're guaranteed a negative return? And whilst that is still happening, obviously risk appetite for Africa, which is a place that very few people understand, is not happening yet. But simply the gap between the positive yield that's available to you in Africa and the lack of it elsewhere will eventually force that dynamic to break down.
I spoke to our Kenyan broker a little earlier on, and he was saying that the foreign investors haven't really left the Kenyan markets because it's providing so much value. What are your thoughts on the Kenyan markets and the type of value it is currently offering? It's
showing pretty good value. You know, the last year, up until about 6 months ago, Kenya was that horrible inflection point of interest rates, Reserve Bank policy, inflation, value of currency and so on, but that's all starting to settle itself down. Kenya is very much the focus of where everything in East Africa economically will get run from, so the story's starting to look good and sound again. Again, their market came off a long way, so there is a decent amount of value around for those who want a bit of risk appetite. As with all of these things, the opaqueness of when you're going to see your return is the problem, but Kenya is a good story and we like it.
Let's look at the horticulture sector. They export pretty much a lot to Europe, but if things turn around in Europe, Kenya will feel the pinch.
If things improve in Europe, absolutely. I mean, that sector will just grow and grow and grow. From a know-how point of view, that's an industry that Kenya is really good at, plus its proximity to the European markets. Any improvement in Europe and that sector will really, the agricultural sector of Kenya will feel it.
And let's look at Nigeria. The Naira has come under significant pressure, but the CBN says they've got enough muscle to act if anything goes wrong in Europe. We did see a positive outcome out of Greece. Your thoughts on the type of dynamics that are playing out in Nigeria at the moment?
I think Nigeria, I think this is what's happening with the currency is something that should have been happening over the last 12 months anyway. Their currency is actually held extremely steady against the majors and the US dollar. And in a country where you have around 10%, I think it is, inflation, you would like to see obviously a steady depreciation of the currency. Unfortunately, they never worked like that. So all the Naira is doing now is taking up that slack and just showing a little bit of a depreciation to catch up with what inflation's done locally and its relative value against the major currencies. I don't think there are any structural problems there. Obviously, Nigeria has immense problems, but the authorities seem to understand them and they're battling them quite well.
Looking at South Africa, Europe is our largest trading partner, but we have tried to diversify our goods through to China, but still not as robust as we'd want it to be. So looking at South Africa, what type of scenarios could play out there?
South Africa's got to look at strengthening its trade ties in its own neighborhood, i.e. Africa. So corporate South Africa's got to look at ways of growing that market out there for their own benefit. And obviously South America and Asia and so on. The European problem as we know it in the absence of any real political will, this problem will drag out for a long, long time to come. And South Africa should not be relying on the Europeans getting their house in order to try and help ourselves. We've got to actually look at the problem ourselves and come up with a different kind of strategy.
So it's still going to be a long, drawn-out recession, or could we be heading into another recession?
We are heading into another recession in Europe. I think that everybody pretty much admits that now. And it's not surprising, but the problem in Europe is largely a political one. It's the inability to take the pain that is necessary to try and move the process into a different dynamic. And whilst that remains in play, there's going to be no real solution to the problem. Right. It's just buying more time.